My oh my, what the heck is happening? The CBOE volatility index is spiking, OPEC can't strike a deal, so WTI crude is at its highest level in 6 years, aka oil is at its highest level in 6 years, and we're finally just now starting to think that maybe inflation will inflect downward. But now, because we're seeing a spike in oil prices, people are freaking out, thinking, oh my gosh, is this going to drive inflation higher? We already know that there are linkages between producer price inflation going up when oil prices go up, and so the market is starting to freak out. The S&P 500 is down 0.5%, the Dow is down 1%, and look, I know this is kind of small for the indices, but it's definitely a change in direction for the indices, especially since as soon as just this morning, they were hitting all-time highs, and now they're not. And at the very same time, yields on the 10-year have just plummeted down to 1.37, which is usually good for stocks, but apparently now it's not good for stocks. All at the same time as Amazon is up 4.5%. So what the heck is going on? Let's talk about that. Also, stay tuned because I'm going to talk a little bit. I'm going to give you a little guide, although I'm not going to reveal the exact trade. I'm going to give you a little bit of a guide as to how this morning I took advantage of an option contract that gave me a $187,500 credit. And I didn't even have to risk that much money relative to the credit I got. I'll tell you a little bit more about that. As usual, though, remember that I share every single buy and sell alert that I make in my Stocks and Psychology of Money group, which you could join as well. I have extended that coupon code briefly, linked down below, the I'm Not Leaving code. We had some trouble streamlining, increasing the prices, but we will be increasing the prices again. As soon as that I'm Not Leaving code is over, the prices will be going up. And so, yeah, sometimes you hear that there are coupon codes, sometimes there aren't, but the price does go up over time. The net price goes up over time. So check that out, link down below before that price goes up. All right, so let's put the puzzle pieces together of this messy puzzle game. So let's break this down. First, why is volatility up? Well, first of all, volatility measures fear. It measures a rapid change in underlying prices, kind of like a rapid reshuffling in the stock market. So when people are quickly shifting to different places and we see rapid fluctuations in prices that we usually don't see, we tend to see CBOE volatility up. Okay, so people are reshuffling. Got it. So where are they going and what are they leaving? Great. Let's talk about that. But first, we have to know a little bit more. We know that the second thing that's happening is, why are bond yields going down? Because that's actually going to give us a little bit of insight into what the heck people are doing. So bond yields going down. All right, let's unpackage that a little bit. If bond prices go up, that is, bonds become more expensive, then yields go down. You're paying more for a set amount of money, so the yield goes down. Got it. So basically, yields falling means bond prices are going up. Well, if the price of this buy the dip coffee mug is going up, then there's either a supply shortage or there's a lot of demand for this coffee mug. And in the case of bonds, there's a lot of demand for the bonds. Hence why, when bond prices go up because there's lots of demand, yields actually go down, which is what we're seeing. So bond prices going up means more people buying them coffee mugs, more people buying them bonds. Okay? So more people are buying bonds. Why would people be buying bonds? Well, people would buy bonds if they potentially suspect that inflation is going to go down. Because if inflation is going to keep going up, then you wouldn't really want to buy bonds that yield 1.37% on the 10-year, right? It doesn't make a lot of sense. You would see generally bond yields go down when more people are buying. Now, the Fed has been buying, but they've been buying at a consistent rate. And so the market is coming in actually buying more. They're not offloading these bonds like crazy, leading yields to go up like they did at the earlier part of the year. And so, in case any of this bond stuff is confusing, think of the bottom line. What are people doing? Well, people or banks or institutions or pensions or hedge funds are saying, hey, we need to put a little bit of money, or maybe a little bit more money, into safety. Into the safety of bonds. Into what if inflation does start inflecting down and we end up having a little bit of a risk of deflation, potentially. Who knows? The point is, the flight to bonds, no matter where you stand on the inflation debate, because I know half of you are, hey, big inflation is coming, and half of you are saying no inflation is coming. I get it, and I respect that. I think it's very good that you have your belief and you stick to it, and then adjust based on whatever data you're seeing. But the point is, when bond yields are falling, it sends a little bit of a signal that for some reason, parts of the market are fleeing to safety. Okay, this is interesting because if you now look at which stocks are down, you see a little bit of a flight to safety as well. Think about this. If we do have an inflection to lower inflation going forward, then generally people flee to growth stocks because that way you could still get growth in a low growth era because growth stocks are, well, growth based. And value and recovery stocks get beat up. This is why most of the recovery stocks like Dave & Buster's or Cheesecake or the airlines are down today. They're all red today, right? But what's really crazy is, and this is something else, is if you actually look at most tech is actually also down today. But the tech that is up, or not down as much, is tech like this. Amazon, up 4.5%. Apple, up 1.5%. Google, AMD, either flat, tiny little bit down, or tiny little bit up on the day. While at the same time, you got higher risk stocks like SPACs, which have a lot of growth, whether it's fintech growth like SoFi or growth like Tesla, but more uncertain growth suffering, down 3 to 4%. That's a lot. And so what's happening, folks? We have a flight to safety that's happening today. Now, how long this flight to safety will last, we don't know. But what we're seeing is we're seeing an escape from all forms of higher valuations. Recovery, higher valuations gone. SPACs, higher valuations get away. Higher valuations in tech get away. We're seeing a flight to safety in bonds, and we're seeing a flight to safety in stocks. And that flight to safety in stocks is FANG, because you get a combination of safety against inflation because you have growth, but you also have safety against potentially deflation because these are lower valued growth companies. So they still grow and they have lower valuations, so you're paying less of a premium for that growth. It's kind of like why people are going into bonds. It's flight to safety. And so in my opinion, this is a little bit of what's going on. We have a flight to safety assets. Now, how can you make money if you believe this flight to safety is transitory? That is, you think people are, for the short term, going to go into a flight to safety, and then eventually when the flight to safety stocks like FANG become really expensive again after they break out, then people are going to transition again into a little bit more risky tech stocks or consumer discretionaries or other growth stocks that were originally looked at as a little bit highly valued, but now because FANG has maybe shot up again, the others start catching up again. So in other words, if you believe that you want to be a long-run owner of certain growth companies or SPACs or higher valued companies that are all red today or mostly all red today, then what's a strategy you might take advantage of in an environment like this? Personally, the strategy is selling puts. And that's what I announced this morning in my Stocks and Psychology of Money group. I sold a very specific stock with very specific expirations, and I was able to make $167,500. And worst case scenario, I have to buy $438,000 of a stock I want to own anyway. So in other words, if you divide 187.5 divided by 437.5, I made a 43% return instantly on a stock I want to own anyway. So in other words, I could have just bought the stock today, or I could have taken this extra 42.8% with me. Now, there are things that go into this, like opportunity cost and collateral, but sometimes using collateral is okay when you're not otherwise looking at making other moves or buys. I mean, anytime you make one decision, you have an opportunity cost to consider. But folks, this particular option move, this was a no-brainer for me this morning. Absolute no-brainer. And so what I recommend you do, if there are companies that you're looking at where you're like, I want to own this, I want to buy the dip, You know, we're gonna hodl this thing to the moon. I want to be exposed to a bigger position here. Consider selling some puts. Now, always remember that options come with risks. So you have to fully understand options risks. And I'm not the person who's your financial advisor who can fully explain to you all of your particular risk. So remember, if you lose money, don't sue me, bro. But if you go to the moon with me, hit that subscribe button and we'll see you in the next video. And hopefully you'll use that extended coupon code linked down below before the price does go up. Because yes, the price does go up over time. Last year, the course was selling for a cost of $200 less. Now, it didn't include technical analysis and options, which it now does. And see, that's what I stand for. Sure, price might go up, but value goes up more. Thanks so much, and folks, we'll see you in the next one.